So today, we're going to dive into one of the biggest, most important ideas in all of finance, credit risk management. Now I know, it sounds super complicated, but I promise you, it all boils down to a really simple question you've probably asked yourself before.
All right, think about this for a second. Imagine a good friend comes up to you and asks to borrow $1,000. What happens in your brain? Before you even think about saying yes or no, you're already running a bunch of calculations, whether you realize it or not. You'd probably run through a mental checklist, right? You'd ask yourself, are they generally a reliable person? Do they have a steady job? Have I ever heard stories about them kind of not paying people back? And maybe most importantly, how are they actually planning to get this money back to me? That little voice in your head, that's the very beginning of credit risk. Now, here's where it gets really interesting. That simple, intuitive thought process is exactly what banks are doing. They're asking the same basic questions, but instead of for one friend and $1,000, they're doing it for millions of people and businesses. And we're talking trillions of dollars. And it's that incredible scale that makes this so important. This isn't just some abstract financial concept. We're talking about the single biggest risk to any bank's survival. And when things go wrong, it can threaten the entire economy.
So let's put an official definition on it. The Basel Committee, which is a big deal in global banking regulation, defines it just like this. It's simply the chance that someone who owes you money, a borrower, isn't going to pay you back like they promised. Plain and simple, it's the risk of default.
And listen, this is not some small side issue. The same committee says it loud and clear in this quote. The number one reason big banks get into serious trouble again and again is because they get sloppy with this stuff. Their lending standards are too loose, or they just do a bad job managing all the loans they've made.
So why is it such a huge deal? Well, first off, lending money is a bank's main business, so loans are, by far, their biggest asset. Second, the profit a bank makes on any single loan is actually pretty small, so it only takes a few loans going bad to completely erase the profits from hundreds of good ones. Third, this risk pops up everywhere, not just loans, but in financial trades and guarantees, you name it. And finally, and this is the big one, if a major bank fails at this, the fallout doesn't stay inside the bank. It can spread, and spread fast.
Now, banks have to think about this on two different levels. On one hand, you have the individual loan. That's just like checking if your one friend is good for the money. But then there's the other level, the entire portfolio of loans. And this is where that friend analogy is super helpful. It's not just about one friend. It's about making sure you haven't loaned all your money to a bunch of friends who all work at the same company that might go under. You can't put all your eggs in one basket. That's portfolio management.
So when you're facing a risk this massive, you can't just go with your gut. Banks needed a system. They had to develop a whole discipline to turn what used to be the art of lending into the science of risk management.
And that's what credit risk management is. It's a whole process built around one main goal: to make sure the bank is getting paid enough for the amount of risk it's taking. See, it's not about avoiding all risk. Lending is always risky. It's about taking on the right risks and managing them smartly.
So how in the world do they actually do that? Well, this huge, complex job can really be boiled down to a pretty straightforward four-step cycle. This is the core framework for how it all works.
Here's how that cycle looks. First, you identify the risk. You have to recognize it in every single thing you do, from a simple car loan to some super complex financial product. Second, you measure it. You have to actually put a number on it, using tons of data and fancy models to figure out the odds of default. Third, you monitor. This never stops. You're constantly watching every loan, every borrower, looking for any red flags. And finally, you control the risk. You set limits and create policies to make sure you're never too exposed in one area, and then the cycle starts all over again. It's a constant process.
Okay, I get it. This might all sound like something that only matters to people in suits working in skyscrapers. But trust me, the way this process is handled or mishandled has a huge direct impact on your life.
When banks get this right, when they manage credit risk well, they feel confident enough to lend money. And that lending is literally the fuel that makes our economy go. It's how businesses get the money to grow and hire people. It's how you can get a mortgage to buy a home or a loan for a new car. Good credit risk management is the bedrock of a healthy economy.
But when it fails, the results can be absolutely catastrophic. We all saw what happened with subprime mortgages back in 2008. That was a massive, system-wide failure of credit risk management. And it didn't just hurt the banks, it nearly brought the entire global financial system to its knees. So yeah, this isn't just a banker's problem, it's everybody's problem.
Which really brings us to the core challenge of all of finance, right? It's all about finding that balance.
How do you take on enough risk to keep the economy moving forward, to help businesses grow and people buy homes, but manage that risk carefully enough so that the whole system doesn't come crashing down? That's the tightrope that bankers and regulators have to walk every single day.